In the wake of recent big bank failures, does the Fed have their eye on raising rates to Mount Doom on the warning of the spring housing market? Or will they realize that the return of the banking disasters would scare away Americans from the market and chill out any further rate hikes? Also, home sales spike, mortgage demand increases again, and the war between millennials and boomers heats up. Why in the world is California charging rich people more to sell their homes? Join the two towers of Ray and Dan this week as we dive through those stories and more this week in real estate. Yay! We're here.
Yes, I wrote that in 30 seconds. That is so good.
That was great. Yeah. So today we are talking about the Fed. We're going. So what we've decided to do, we're trying to make our show more concise to make it within an hour. We have 13 news stories to cover, plus the Fed announcement. So on days like today, where the Fed is going to be doing their thing, we will be going live around 12:15 or so, that 12:15 Central Time. That way at 1 o'clock, whenever the Fed makes the announcement, we will be able to break that news to you live. So thanks everyone for joining the show. We're broadcasting live on Clubhouse, YouTube, Facebook, LinkedIn. So wherever you're joining us from, we really appreciate it. Be sure to do all the YouTube-y things, subscribe, hit the bell. We have tons of great comments in the chat, which we're going to be getting to. Mike V was first for the record on YouTube. The what?
Just do the YouTube-y things.
Yeah, do the YouTube-y things. We need to get up to like 1,000 views because then we get to do more stuff. But thank you guys for joining us in the comments. We're going to get to your comments each time we talk about one of these news articles. Speaking of news articles, why don't we just dive in and get started, Dan?
Let's go.
All right, first up, let's talk about the Fed. We know that they're about to raise rates, or will they leave rates the same, or will they make them go down? I don't think anybody's predicting that. So drop in the comments your prediction. What is the Fed going to do? Are they going to raise rates? If so, how much? Are they going to leave rates the same? What do you think? This article comes to us from CNBC. It says, amid the turmoil of the financial sector and uncertainty ahead, the Federal Reserve will likely approve a 0.25 percentage point increase. So 0.25 is what the Fed is calling. That will mark 1 year since the central bank began the current rate raising cycle. Over the last 12 months, inflation spiked 40-year high and only recently started to ease, but all of that monetary policy tightening has been tied to issues that are disrupting the banking industry now. For consumers, it means they'll still pay higher price to borrow while continuing to grapple with persistently high cost of living, while suffering a crisis of confidence when it comes to their savings accounts. Rate hikes 1 year later. For its part, the Fed has already hiked its benchmark rate 8 times over the last year to its current level of 4.5% and 4.75%. The federal funds rate, which is set by the central bank, is the interest rate at which banks borrow and lend each other money overnight. But the Fed rates also influence consumer borrowing costs, either directly or indirectly. This is for you, all the lenders who message me are like, the Fed's going to rate hikes, doesn't necessarily, either directly or indirectly, including the credit card, mortgage, and auto loan rates. So the CNBC website does have a really good graph that just kind of shows this stair step since the end of first quarter of 2022. It's basically stair step rate increases all the way to where it is today. The average mortgage rates, I just want to mention this number. Mortgage rates now average 6.66%. Hang on. 6.66%. Although the 15 and 30-year rate mortgage rates are fixed, it's tied to the treasury yields and the economy, which everyone shopping for new home rates has lost considerable purchasing power, partly because of the inflation and the Fed's policy moves. All right, so Dan, what is it for the record, Dan? What do you predict will happen from the Fed?
I already predicted this, and I have a video if you want to go watch it on my channel. I'll drop my tag. It's just D-Lettergrux everywhere, but on my personal channel on YouTube, I already predicted 0.25.
You predicted 0.25. I think it's 0.25.
I'm hoping that they don't do anything, that they just, because there's more banks in trouble than just the 3 that have failed so far. Now, again, in my video, I broke it down. I don't think they're all necessarily related to the housing market, but as Christina M. Smallhorn said on the show last week, what's the first thing you think about when you think about a bank failure? You think about the housing market crash. So I don't think they should push it up, but if they do, it'll be 0.25.
Dusty said they'll do whatever the worst option is. Olivier's, he's predicting the 0.25. He says, I think they have to leave it the same or raise it 0.25. He said that inflation is coming down north of the border. This is our Canadian correspondent. So that is good news.
We've been lagging behind them.
Yeah, well, yeah, they're raising rates and doing stuff just before we are. So,
right.
Our inflation is still high and lagging behind. Mike V, he says we won't be seeing 2% inflation this decade. Expect 5 to 6 annual from here on out. Ooh.
Which then, what does that do? Where would that keep rates in the 5-6% or higher?
Yeah, I mean, I would say 6%, right? The back in the day, they used to say that you need to make at least 6 to 8% on your money per year to keep up with inflation, taxes, and all that jazz. So, well, we're talking about where to put your money. Is it still a safe bet to put money in real estate, Dan?
Now, I feel like that was a lead to the next article, but I don't have that title as the next article. So I don't know. I hope that we're on the right one.
Sure. The home sales spike, right? That's why you keep your money there.
Yeah. Home sales spoke. They spoked. Let's see. I have 800 up, Ray. All right, here we go. Home sales spike 14.5% in February as the median price drops for the first time in over a decade. The median price, Ray, not the average. The median, the middle. Okay.
I like it.
Sales of previously owned homes rose 14.5% in February compared with January, according to the seasonally adjusted count by the National Association of Realtors. Hey, that's us. That put sales at an annualized rate of 4.58 million units. Yeah, so Ray, we're 2.5 million units away from where we need to be if that's where the sales base is going to be. It was the first monthly gain in 12 months and the largest increase since July of 2020, just after the start of, and I'm going to say it here, the COVID-19 pandemic. I said it. Sales were, however, 22.6 lower than they were in February of last year, which these gaps are getting smaller, Ray. Remember, they were like 85% difference, 65% difference. Now they're getting a little closer, which we kind of expected. These sales counts are based on closings. So the contracts were likely signed at the end of December and throughout January when mortgage rates had fallen sharply. So it's kind of a lagging indicator there. The average rate on the popular 30-year fixed loan hovered in the low 6% range throughout January after reaching a high of 7% last fall. And here's a quote from Lawrence Yun. He is the chief economist for the realtors, they say. Conscious of changing mortgage rates, homebuyers are taking advantage of any rate declines. Moreover, we're seeing stronger sales gains in areas where home prices are decreasing and the local economies are adding jobs. Now, Ray, I had a question on this one for not only you, but just kind of everyone listening on Clubhouse and on YouTube and everything. What is this going to do to the housing market? We have no inventory and sales are spiking right now. That can't be a good thing.
Well, it looks like, if a lot of the people maybe listening to the call would remember just last summer, it seems like, and we're going to get into this, there's an article we're going to cover it a little bit. That sounds like an all familiar tune that we all dealt with last year. But let's talk about mortgage demand, because you would think if the rates are going to go up, if this thing's going to get crazy and out of hand, then surely mortgage demand's going to go down. And you'd be thinking wrong. Mortgage demand increases again, but interest rates are rising. What? So mortgage demand is increasing for 3 straight weeks now as interest rates dropped in response to the recent bank failures. But rates are rising again, and that could damper application volume this time. Total mortgage application volume rose 3% last week compared to the previous week, according to the Mortgage Bankers Association seasonally adjusted index. The average contract interest rate for a 30-year fixed mortgage with conforming loan balance $726,200 or less decreased to 6.48% from 6.71%, with points decreasing 0.66 from 0.79. including the origination fees. And that, of course, includes 20% down payment, yada, yada, disclaimer there. Treasury yields declined last week, driven by uncertainty over the health of the banking sector and worries at the broader impact on the economy, said Joel Kahn, MBA's deputy chief economist. However, mortgage rates have now dropped as much as Treasury rates due to the increased MBS market volatility. Applications to refi a home increased 5% for the week, but were 68% down from a year ago. Mortgage applications to purchase a home increased 2% from the previous week and were only 36% lower than the same week a year ago. And the reason why I say is only because it was crazy. It was still super low rates. So it wasn't as low as the year before, but it was still super, super low rates last year. So with fears of the banking sector subsiding somewhat, in the latest financial markets, mortgage rates moved higher to start this week, according to a separate index from the Mortgage News Daily. On Tuesday, it put the average rate at 6.75%. So everyone's watching the Fed. As a matter of fact, at the bottom of this article, it says, all ears are on the Federal Reserve, which is expected to raise the federal funds rate. I feel like they've sufficiently leaked the 0.25% interest rate, and most of that is going to be completely no surprise and already priced into the market. I don't see that this is going to be a big what moment.
Right. We've never gotten any of these on, any of these announcements. None of them have really been a surprise. But Ray, do you know what a surprise is to me? I didn't know this one about this next article.
I think I do know this surprise, and it is rather shocking because I didn't know that physical property could even do this.
So existing homes are getting smaller, Ray. No, just kidding. It's new construction. The title reads, new one-bedroom apartments get smaller. New one-bedroom apartments get smaller. Now under 900 square feet. Which to me wasn't, that size isn't shocking necessarily. My first couple of apartments were 3 bedrooms and 2 baths in just over 1,000 square feet. So they were really tight and cozy, but no, they were 2 bedrooms, 2 baths. But so I don't know, 900 square feet for a 1-bedroom apartment seems like a pretty good size to me. Anyway, new apartments in the U.S. saw their average square footage go down in 2022. That's a report from Rent Cafe. A real estate website. Whoa, I hit the wrong button, Ray. Hold on here. There we go. The real estate website found that new apartments sizes went down 30 square feet over a 12-month span, coming in at an average of 887 for 2022. The last year's reduction in space marked the sharpest drop in 1 year, and to some extent stemmed from studio and 1-bedrooms seeing an increase in what proportion of the market they make up. And again, that's according to Rent Cafe. In 2021, the nationwide average for new apartments was 917 square feet. The report said the year prior to that was 913, so they went up a little bit, then down. And pre-pandemic 2019 averaged 910. So they kind of hovered in the same size, and now they've gone down 30 square feet. According to the report, the average amount of space offered in a new apartment last year varied by region. The 3 regions with the most square footage on average were the South at 993, the Southeast at 983, and Western at 923 square feet. So Pacific Northwest, these are the smallest now. Pacific Northwest, 776 square feet. I think most of that is driven by Seattle. Seattle has tiny apartments. California, 876 square feet, which isn't surprising to me. And then Mid-Atlantic is 881 square feet. So what does that do for rents? If the size is going down, rents can't keep going up, right?
Au contraire, mon frère. I bet they will continue to go up.
Little culture, little wee ho ho.
Oui, yeah, no, yeah. I don't think that's going to make a bunch of difference. But hey, in honor of talking about apartments on the show day, one of the most famous apartment complexes, the Seinfeld. Anyway,
there you go.
All right, so we've gone from the smallest little home, the apartment, the smallest single family properties. The size of these properties are shrinking. So what's happening to the biggest? Those big luxury deals? What's going on there, Dan? Whiplash. That's what's happening. So this report comes to us from Inman. It says, quote, all strapped in, luxury clients face whiplash as banking fallout unfolds. So this is a rather long article on there, but check it out. If I don't know if you have to be a subscriber to see this one or not, but we'll go over some of the basics. Faced with an unraveling fallout from the failures of the financial institution, some luxury sellers have chopped prices while buyers press pause as the crisis unfolds. Real estate agents of one percenters revealed to Inman. In Orange County, where the median sales price of a detached home declined 7.6% to $1.174 million in February, at least one luxury home seller was spooked enough to quickly accept a lower bid on the home he was selling, presumably to ensure a smooth sale before the potential headwinds from the collapse of the SVB and Signature Bank gain force. Where's the quote on this? It says, I had a seller who accepted an offer we received for a price that he would have dismissed 5 days ago, just because he was worried that the Silicon Valley Bank is a potential snowball of something greater to come down the road in a negative way. I think it is anecdotal, but it does embody a larger picture. I doubt I'm the only one in this position. This guy's name was Gio Helo, Helou. He's of the Oppenheim Group. Oppenheim? Like Robert J. Oppenheim?
I thought it was Oppenheimer.
Oh, that's right. That's Oppenheimer. Okay.
Yeah.
So a lot of these are quotes from real estate agents. They're anecdotal reports about what's going on around the country, which it kind of happens on our show a lot. This agent says we have clients that put their decisions on hold for a while we watch for additional fallout and for other bank losses. This was Benson. What's Benson's first name? Benson told Inman in an email. However, they are still buyers, and as one buyer stated this weekend, just waiting to be safe, still plan to buy soon. Oh man, I wish I could find that guy's first name, or girl. Just say Benson. So I want to give credit to where credit is due, but I don't see their name.
I always do the same thing. I search through when they don't give a full name, and sometimes they don't.
Agent spoke with Inman, said that clients seemed somewhat reassured by the Fed, Treasury, and the Federal Deposit Insurance Corporation for swooping in on Sunday to ensure that all depositors in SVB and Signature Bank would be repaid in full. But it was clear by Thursday as Credit Suisse received a $54 billion influx of cash from Switzerland's central bank, and several U.S. banking giants funded a $30 billion lifeline to the First Republic, that market uncertainty was far from over. This quote was from Jeff Marples of Marker Luxury Properties in San Francisco. The SVB collapse, I think, is a much bigger concern leading up to Sunday night. Now it's just a matter of if we're all strapped in the seat and if we're on the roller coaster movements in the market for a while. Somewhere down the line, it will even out. All right, so it's just report after report of people saying that their luxury clients are waiting. Their luxury clients are putting things on hold. There are some that say they haven't seen any deals canceled over it, but we know that there have been some. In my market, I just want to make this kind of macro, I guess, but in my market, we're not noticing a huge difference in luxury. All we're seeing is that the luxury supply is increasing. Pre-pandy, luxury supply was at an 18-month, and it went down during the pandemic.
Yeah,
and
didn't it go down to months of supply?
Yeah, it was like 8 months of supply for a while, and now that's starting to go back up again. So it's returning to normal in my market, and we're not seeing, I guess we're relatively detached from what happens in Silicon Valley here, but we're not seeing a huge pause on luxury purchases, but because of what happened with SVB. I think there are people that are concerned with what's going on with the broader economy and the Fed, and they're maybe taking a break or looking at things. I do see that our luxury clients are looking more intently at the numbers right now than they have been in the past. But I just think that's due to market uncertainty. So maybe if the Fed does raise rates, maybe if we can get on a standard pattern and everybody kind of knows what to expect from now on, they see the inflation numbers start to moderate, then I think they'll feel more comfortable moving forward. But it's not specifically in my market for SVB. How about you, Dan?
No, it's the same thing. It's not really, it's just interest rate driven really right now. And then kind of, I mean, it's not really driven by what can I get from sellers in from what I'm seeing. You know, can I get a $5,000 or $10,000 credit? It's really just kind of wait and see. Let's wait and see where the
Yeah.
where interest rates go, and let's wait and see where the market goes. I try to have the proper conversations with people because a lot of things I hear is, well, when the market comes back down, and I don't, and I think it will hunker back a little bit, but coming down in the next 6 months after going up for another 4 months isn't gonna save you any money, you know. So it's just gonna a lot of wait and see.
Dusty Martin said, my luxury market has returned to normal pre-pandy, which means buyer's market, 10 to 13 months of supply, things over 3 million, 1 to 3 months, or even more balanced.
Yeah, she has a really volatile luxury market, it seems like.
Oh, the Millennial Wealth Builder said Gio is from the Selling the OC Netflix.
There you go. Hey, Ray, do you want to know who is going to most likely be putting a lot of things on hold after April 1st?
Yeah, I'd love to know. Oh, wait.
So good. We both just paused him. Yeah. All right. So here's the title. And this article, I think we should deep dive this, Ray, because I just want to go off. I didn't even know this was the thing. I'll be honest with you. But
May have to mini go off.
Yeah, I have to mini go off. I don't sell homes over $5 million, so I don't know. $1 million listing star warns California mansion tax will deliver hardest hit to market since 2007. Now, that's a bold statement, and I don't necessarily disagree. I don't like the, another crash is coming, the bubble boys and all that stuff, but this one is pretty intense. So California law called United to House LA establishes a 4% tax on home sales at $5 million up and 5.5% on sales at $10 million up. I'm going to reread that so you guys can hear it. Yeah. The California law, which is already in place, it's going to go into place. It's going to go into play April 1st. So there's your April Fools. A California law called United to House LA establishes a 4% tax. It's on all fake sales. News. This is real news. 4% tax on home sales at 5 million plus and 5.5% on 10 million plus. So I guess this is their thought of stealing from the rich and giving to the poor. But I have a lot of thoughts on this. So I'll get through it. And if you want more, this article is on Inman, I believe. If you want to see that, Ray, I think it is on Inman, I believe. But and there's a video here. So the reality star from $1 Million Listing is Josh Altman, who we all pretty much know. So though it's home to some of the most luxurious and expensive real estate listings in America, California is readying to pass a housing bill that $1 million listing agent warned could create the hardest hit to the market since 2007, 2008 crash. So he says there's a video there. You can watch it. He says in about 10 days or so, there's a measure called ULA that's going to go into effect, which is going to probably be the hardest hit to the real estate market that we've seen since 2007. So Altman's comments come in response to the recently passed ULA, which adopts a so-called mansion tax on property sales tax transfers over a certain value to pay for affordable housing. So now he says there's a lot of points here. That's why we can just mini dive it now, but there's a lot of points here. Like imagine if you're someone that just had generational wealth, right? And you were given that house. You live in this house. It was passed down through generations. You inherited whatever. You don't really pay a mortgage on it. You just pay the property taxes every year. Or what if that's covered from a trust fund, whatever. And now you want to sell the house or you need to sell the house. Now you have to pay 4%. You have to pay another $200,000. You have to write a check for $200,000 to sell your house. That's after real estate agent fees and all that stuff. It's absolutely crazy.
How about that?
It's absolutely insane to me. So it goes into a lot more detail, but property sold over 5 million, but below 10 will be at 4%. Over 10 million will be at 5.5%. and it says, the article says, at least 92% of taxpayers' money would fund affordable housing under the Affordable Housing Program and tenant assistance programs under the Homeless Prevention Program, because we're not throwing enough money at that now, and it's not solving the problem because we're throwing money at it in the wrong ways. We're not throwing money at it in the right ways. We're not helping the people. We're just saying, here's more money, here's more money, here's more money. And people are absorbing this money, but it's not going to the actual issues, right? I don't want to call it a problem because homeless people are people, they're humans, but it's an issue. We need to address it, and we need to address the humans and help them, not keep throwing money at it. And we don't need to take money from quote unquote rich people, because Josh says in the video that, you know, a 4,000 square foot home in LA, in the right parts of LA, that's $5 million. You know, that's not necessarily rich people. So you're misguided. It's extremely misguided here. And he also says that what this is doing is it's forcing a lot of deals to go through before that day hits that shouldn't be going through. You know, he said he has one, I think it's a $28 million listing. They're offering $1 million bonus to anyone who can close before the first. Just all these crazy things to happen. So either people just aren't going to sell at all, or what are they going to do? They're going to go around real estate agents. They're going to do it off market. They're going to do whatever they can to not have to pay that. That's an exorbitant amount of money to have to pay. And it's ridiculous. It's absolutely ridiculous. Why? And if they did work their butts off to make that money and are rich, why, again, why take the extra taxes from there? They're already being taxed for it. Take the taxes somewhere else, you know, maybe in goods they buy or something, but why from their home? Why are they different just because my house is worth 500 and theirs is worth 5 million? Why? It doesn't make any sense to me. So the Los Angeles City administrative officer estimated the proposed tax could generate 600 million to 1.1 billion in revenue each year. So do we really think no one's going to skim off the top of that? No one's going to make any extra money and buy extra boats, and all of a sudden city officials are driving Bentleys? I mean, this is ridiculous. I'm almost swearing now, and I know I'm not supposed to on this show. But however, he noted it could fluctuate based on how many property transactions with values within the scope of tax actually occur, which I expect that number. It's already, the number, the days on market and the amount of inventory is going up. It's just going to force this to go up. There's going to be no sales. It's ridiculous. So anyway, I'm going to stop so we can move on to the next thing.
Hold your mini rant. For more, find Dan on his Instagram. That would be a good short for you to really kind of dive into this. I know it's more of a local issue for you, but
yeah, it is. But I mean, it's absolutely ridiculous. I think it's stupid. It's pointless. And again, I think it's from Inman. If you want more on that,
it's actually Fox Business.
Fox. There you go. Yeah, and the host really tries to hit him. It's really ridiculous how he tries to come at him. And Josh says, "Look, shut up. I'm here to talk about you, LA." Because he's like, if you live in LA, they can just live in front of your front door and there's nothing you can do about it. Is that right, Josh? I mean, it's just stupid. Like, dude, be there to talk about the issue. And yeah, homelessness is a crazy issue in LA. Downtown LA right now is like a war zone. But I mean, dude, talk about the issues. Don't make it all, I told you, because they're going after California. I know it. But anyway, it's absolutely ridiculous. This is stupid. He's an English Fox.
Yeah. Fox Business has several English commentators, but we have a great comment that's also a perfect segue into the next. Shelly Snowden says, "I've sold real estate for 23 years. I made it through 2007. Do you feel it will be worse now?" That's a wonderful. I love the comment on LinkedIn too.
Yeah,
we love seeing the LinkedIn viewers tuning in live, so I appreciate that. But also it's a perfect segue into this because we were talking a little bit about what's happening in the marketplace and what's going on with inventory. And I think inventory is really the cue. So this article is on Inman. It says the spring 2023 market. So 2021 all over again. That's the title. It says agents get to work as spring home buying arrives. For months, one question has loomed large in the minds of professionals: will the housing market roar back to life in the spring? Now, this is something I would throw out there as an aside. If you're a commenter, drop a comment. What's happening in your market? I personally feel like the market is about 2 weeks behind so far. So I think it's coming. We're having tons of discussions, which that usually happened in February. But I feel like the tons of discussions right now is happening in March. So I would say it's like 2 to 3 weeks behind what it normally is seasonally. So it's a question that arose from a slowing market of 2022 when the rising mortgage rates sapped demand for new loans. Suddenly, after 2 years of intense competition and endless bidding wars, both home buyers and sellers seemed to take a step back. The slowdown continued for most of 2022. In our market, it was really from October-ish to December, January is when people kind of seemed to take a step back. And that trained all eyes on this spring, which officially began Monday. After all, spring is when the seasonality typically indicates that a housing market after winter and I'm going to skip that sentence. I totally butchered the sentence. It doesn't matter anyway. It's basically seasonally.
Right, there you go.
I don't know what's happening. Already there have been positive signs about this spring. The report from the National Association of Realtors this week shows that existing home sales jumped 14.5%, which we talked about from January to February, reversing a year-long trend of declines. And a report from Zillow on Tuesday indicates that tougher conditions notwithstanding, there's still motivated buyers out there. All right, so here's the headings of the next sections of the article. Bidding wars are back. So drop a comment if you're experiencing some bidding wars. Tiffany Curry is among them, an agent experiencing these bidding wars, and described the market that is shifting fast. She's owner of a Berkshire Hathaway home service, Tiffany Curry & Co. in Houston. And she said that one of her listings has been sitting on the market for about 17 days, then suddenly received a full price offer and went under contract. I made a meme about this years ago.
Oh my gosh, this is so crazy. I know what you're going to say.
You remember the meme with the swimmer, the famous swimmer? What's that dude? Phelps.
Yeah, Michael Phelps.
Yeah, and it was the Phelps face, and it was normal and excited, and it said home has been sitting on the market 386 days. And then it was his mad face that he was doing, and then it says agent informs that we have multiple offers.
Right.
And that was what was happening back then.
It's so crazy.
Yeah. All right, so Jessica Lamar with the Tim Cullum Group at House Real Estate in Sacramento, California, described something similar, saying that her buyers are currently facing multiple offer situations and they're having to get competitive really quickly. All right, let me cover some of these other headings here. Open houses are back. So we've done 2 open houses the last 2 weeks, and at both open houses, we had over 30 people come through. That's huge for our market.
That's great for Arkansas.
Yeah, normally an open house would have like 5 to 8 people. So 30 is a lot. In addition to the uptick in bidding wars, some agents also noted that open houses, including those that happened in recent days, have become busier as the winter waned and the spring took hold. Another heading says supply remains a challenge. All right, so what we're really lacking is quality supply. Kimberly J. with Compass in Manhattan told Inman. She spent the first day of spring with a young couple shopping for their first home after receiving a large rent increase. Like other agents, she's seeing the return of things like bidding wars in her market, and there are plenty of home buyers in the area. The problem is not enough supply for everyone. And then there's several anecdotal. This is so Inman does these big anecdotal articles where they just get opinions from realtors around the country. The last heading is the signs so far are making agents cautiously optimistic. It remains to be seen how the year will ultimately play out, but many of the agents who we spoke with them and said current conditions have left them optimistic. Jeremy Cam said you're going to see more and more activity, no different than any other spring or summer season. Okay, so I think that pretty much echoes what we're seeing too. We're having a huge uptick right now, but it seems like people are like just getting out of hibernation and are 30 days away from really exploding and buying a bunch of property if they can find it. That's the biggest if.
There's the big caveat, if they can find it.
Yeah. All right, so let me get to some of your comments and see if you guys are. Oh, sweet. The Millennial Wealth Builder. They said just subscribed. Thanks.
Thanks, buddy. That's awesome. Everyone watching should do that.
That's right. They go on to say my market prices are not falling and little inventory still. Olivier in Canada said, yeah, the market is not getting much better looking at the March stats level. He goes on to say that bidding was in the lower tier market, no activity in the top half. Shelly on LinkedIn she said that my problem is inventory. Yep, me too.
Mm-hmm.
And Matt said he made an offer 100K over and just got accepted 61K over. Wait.
So you talked your way down?
I made an offer 100K over and just got accepted 61K over.
Right. So he started at 100K over and ended up 61K over.
That's
So
some
he talked his
jujitsu
way.
negotiating.
That's backwards, isn't it?
Yeah. How'd you do that, Matthew? Porsche drivers only know how to do that.
Porsche. That's why he's better than Scap will ever be.
Dusty said her spring market is almost half over there in Arizona. March is when we see our largest chunk of closings in Arizona, and some price points are having bidding wars, but not as bad as 2022 and 2021. So I analyzed data in our market for over 65 years, and there was only a slight bump in March as far as March closings go, which means more homes went under contract towards the end of February. This year is not that. I think, and last year was not exactly on that same track, but it was only a slight bump. Shelly said that's insane. Go ahead, Matt. Tell us how you did this. How did you make this offer? Matt now coming to us live from Clubhouse. So thanks for joining us there, Matt.
Of course. No, thank you guys so much for your beers. So there's a house that was priced at $650. We made an offer to escalate up to $750.
Mm-hmm.
We were second.
Oh, the escalation clauses.
Escalation clause.
Yeah. Okay.
Correct. Which are back, and I think people have mixed feelings on that. But regardless, we went up to 100 over. We were not the highest offer, actually, and that offer was accepted, and it fell apart. And so we got ours accepted at $61,000 over the asking price.
There you go.
So we actually came down from our original 100K over by $39,000.
That's good. I mean, if you're going to do an escalation clause, that's the way to do it. You got to go all the way out there, because if you don't, then they're just going to counter your price.
All right.
So,
correct.
Good job.
Matt, speaking of boomers and your generation.
Dan, I'm younger than you are. What are you talking about?
Just barely.
Just barely. I mean, oof.
I'm 40. I'm 40 years old.
Old white-haired man in a Porsche.
Yep. Already in the midlife crisis range of his life.
Mm-hmm. There's a tug-of-war with you, Matt. Let's get into it.
I think he's actually a millennial, but he's the boomer of millennials. So
he's an old soul.
Yeah. So now I can solve this issue, and I've been trying to solve this issue for years, but the tug of war between millennials and boomers heats up this spring. Now, millennials are in the prime of their lives. Boomers are old. They're just going to break hips if they actually get in a tug of war. That solves this thing. Let's just do a tug of war, and whoever wins has to either buy or sell. Like, it's a no-brainer. Anyway, that might be controversial.
My clients do CrossFit.
Yeah, I don't know if any boomers they're like CrossFit. That's for that younger, just stupid.
No, these old dudes in the Masters, man, they'll pull a whole ton of millennials.
There's
soft
there's
millennials.
A few of them. There's a few of them. Way more overweight boomers at this point. Way more out of their prime, out of shape. Yeah.
What are you saying?
I'm in the middle. I'm a Gen Xer, so I'm gonna sit right in the middle and go LOL. All right, so. Although it has barely begun, the spring home buying season has already been cast as the ultimate game of catch-22. Home prices are beginning to loosen despite fluctuating mortgage rates primed to offset the savings. A robust jobs market and coinciding wage growth have placed Americans in the best financial position to purchase a home. Yet that same market has made it difficult for the Federal Reserve, which we're going to cover in just a minute, to slow inflation. Those thorns and other financial burdens have deeply embedded themselves in everyone's budgets. It goes into current market conditions. They've complicated the general flow of housing, generational flow of housing stock. Baby boomers are pushing off retirement and staying in their homes longer as rising rates and price. Well, they were already staying in their homes longer before the market shifted, but that's holding inventory away from these millennials. So there are 44 million Americans who have hit their prime home buying age, which is between the ages of 26 and 35. Sorry, Matt, you're outside of that. Despite common stereotypes about millennials and Gen Zers valuing avocado toast and lattes over home ownership, Multiple surveys show these generations want to purchase homes. That's funny. That's from George Ratui. He is the senior economist for Realtor.com. That's funny. So he says, we heard the mantra, well, young people no longer want to buy homes because of the housing crash. Well, that myth has been busted. That demographic tailwind of millennials and Gen Zers is going to sustain real estate and housing markets for quite a few years. However, Ratui and Windermere chief economist Matthew Gardner said low inventory and worsening affordability will make it more difficult than ever for millennials to break through. And they'll be hard-pressed to find windows of opportunity in the existing home market as baby boomers find little incentive, especially if your house is over $5 million in LA. They find little incentive to move and lose access to historically low mortgage rates. So that silver wave is not coming.
Not coming anytime soon. Well, as Rich Barton said, it may also relate to the boomers and you Gen Xers out there, that the pain may be coming. The pain. See what I did there? Zillow CEO Rich Barton says the real pain is probably coming. So this is on Inman. The writing's on the wall. We are in for some rocky economic times. Zillow CEO Rich Barton predicted in the new interview published this last Thursday. But among the warnings of further disruption in the housing market, Barton's forecast comes with a silver lining, which is financial opportunity. He says, I love the storm, he told GeekWire, a wide-ranging interview that also touched on the health of Zillow's company. Barton said Zillow, which held $3.4 billion in cash and investments at the end of 2022, boasts nearly 200 million in monthly visitors to its website. It's well prepared to weather any storm, including the banking fallout spurred along by the failures of Silicon Valley Bank. He says, quote, a lot of cruft is getting washed out to sea. Is that a California cruft? I don't know.
Keep going. I'll look it up right now.
CRUFT. Referring only to the banking whiplash, but also not only to the banking whiplash, but also interest rates reaching their 20-year highs and layoffs across many sectors of the economy. He says, quote, and if you're an organization or a company that is wearing a bathing suit and a wetsuit, you're all good. And that's kind of how I feel right now. That's what he said.
Huh, weird.
I'm really feeling better than I've felt in a long time. Zillow reported fourth quarter revenues of $435 million, beating most analysts' expectations. And it says trimming its net loss to $72 million. They think they're ahead of the housing market. They think they're in a good position. The rest of this is kind of where they're going and what they think about. He said, this too shall pass. I actually think stormy weather is when leaders are the happiest. It's when the value of what we do as leaders is high. And I don't argue with them completely, because I do think there's something important about weathering a storm and being a good leader through the storm. But it's also nice to have nice economic times. And it's not like I would wish the storm on anyone. But now that we're here, yeah, I know what to do. But that's not the only storm that's happening with real estate companies in the industry. Dan?
So, KW franchisees accuse Gary Keller of illicit tactics in a new lawsuit. So I'm going to hit through this one really quickly. I'm just going to say, I don't know if it's true or not, but I think this is from Inman. Ray, you can correct me if I'm wrong.
Yeah, that's right.
Two Keller Williams Market Center owners have added fuel to the legal saga between Keller Williams, founder Gary Keller, and former CEO John Davis, with a new set of claims that accuse Keller of retaliating against franchisees who supported Davis after his departure in January 2019. Now, if you recall when we covered this, he left on his own. He didn't get fired. He didn't get laid off. He left. And I think that really pissed off big old GK there. So in a petition filed with Travis County, Texas courts on Friday, Colleen and Bart Basinski, sorry if I'm butchering your last name, they said KW CEO GK, President Mark King, and regional leaders Dan Holt and Colette Ching maliciously, quote unquote, maliciously interfered with multiple business contracts that allegedly caused the couple to lose approximately $10 million in investments, disbursements, profits, and income from their roles as market center owners. KWRI coaches and team leaders. That's a pretty bold accusation. LOL. Stupid realtor joke. Anyway, according to the petition, the Basinskis are direct or indirect majority interest holders in a bunch of different markets. Colleen says she developed a strong professional relationship with Davis in 2018 after the former CEO asked her to coach regional directors due to their previous success coaching agents and market center team leaders. The couple alleged their connection to Davis didn't become an issue until former CEO suddenly resigned from his post in 2019. So they keep going on, and then I just wanted to say, let's see, where is it? Where is it? So the spokesperson for GK says it would be premature to comment at this time. However, the Basinskis said the relationship with KWR and Keller continued to worsen in 2020 when the couple refused to follow a new policy that would set a standard preset market cap, which refers to the fees that agents in markets pay. So they're alleging that they threatened to terminate or decline renewal of the market center's licensing, take away high-grossing agents, and place them in competing markets and more subservient market centers, and other oppressive measures to ensure that market centers, including the plaintiffs' market centers, lowered their caps. I mean, that's pretty
Yeah, pretty interesting. Maybe a good time for some other real estate offices to put some females in leadership. That's exactly what happened. Coldwell Banker. Kamini, I may be not saying that right. Kamini. Kamini Lane. She's named the president and CEO of Coldwell Banker Realty. 3 months after Ryan Gorman was outed suddenly as a Coldwell Banker CEO, Kamini Lane has been appointed as Coldwell Banker Realty's CEO and president. Real estate brand told Inman. Liz Geringer. Her role also expanded, and she will take on an expanded role as the president and CEO of Anywhere franchise brands. The appointments mark a significant turn towards a female role leadership at Coldwell Banker, with Lane and Geringer working together in a slightly new leadership structure to manage areas of the brand that Gorman previously led. There's more on this on Inman. Talks a little bit about women in leadership, especially what they're going to do. So you can check that out. Dan,
how about some more women leadership, buddy?
Let's do it, man.
So Long & Foster taps new CEO and president following resignations. The announcement follows the resignations of former Long & Foster Company's CEO Jeff Detweiler and former Long & Foster real estate president Boomer Foster. Okay, Boomer. That was made public on Monday. Excuse me. So this is on Inman if you want to know. We just wanted to touch on it because it's, we always like to touch on kind of changes on these big companies at the C-level and the corporate level. Let's see. Patrick and Jackie stand out.
Because of our earlier discussion about the ocean, I immediately thought of like C-level, SEA level. Anyway,
there you go. Yes, we're talking about, which I live very close to sea level, by the way. Let's see. Yeah. Patrick, that was all of that, Ray, was just to get that sound effect in there. Patrick and Jackie stand out as decisive and proven leaders who have earned the respect of Long & Foster's agents, customers, and employees. That's from Gino Blafari, CEO of Home Services of America. He's confident that blah, 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 they're going to do a great job. And then there's lots more blah, blah.
Blah, blah, C-speak. We're going to do incredibly well in this new
CEO
role.
speak, blah, blah, blah. We looked to the future, and this is literally from the art. We look to the future. We know we can make changes with this ever-changing market, blah, blah, blah. It's a lot
we can write these things by now.
Yeah. It's
my God.
But anyway, we just want to touch on that real quick, but that's on Inman if you guys want to see more.
And this comes just after, I think last week, the founder of Long & Foster passed away. So this news comes just after.
Breaking news, Ray. We were correct.
Wait, hang on. Let's get to the Zillow adding new mapping software first.
Oh.
So this is interesting. Zillow adds new mapping software to show renters' apartment views. So renters looking for a place to live during the pandemic. During their apartment search. So I don't know where I just threw that in there. Renters looking for a place to view with a view during their apartment search can now see for themselves what the outside world looks like. I guess that was in my head, like looking from the outside in.
Yeah.
So Zillow added to its new renter search platform. Zillow announced Wednesday that its partnership with Ingrain will give renters the ability to see what floor their potential dwelling is on, as well as the view outside with the building. So I thought this was interesting. It's something that we kind of have with the Google Street View, but if you're in an apartment, you don't really know what that window looks at. So this also goes back to the earlier article that we did about the shrinking apartment space. Maybe if you can look outside, you'd feel better about the whole thing. So we're investing in integrations and products that make apartment hunt easier and help people get to their next home more seamlessly. Renters want and deserve as much information as possible during their search. So I think this is a good move by Zillow. I like it. I think it's also going to add a lot more information and data on the whole home search scene. But Dan,
here it is.
Breaking news from This Week in Real Estate, hosted by the Bearded Men of Real Estate. That's right, Dan. We do have breaking news. When news breaks, we fix it. The Fed hikes rates by a 0.25 percentage point. Indicates increases are near an end. So the Federal Reserve said on Wednesday that it enacted a 0.25 percentage point interest rate increase, expressing caution about the recent banking crisis and indicating that hikes are nearing an end. Along with its ninth hike since March 2022, the rate setting Federal Open Market Committee noted that future interest increases are not assured and will depend largely on incoming data. The committee will closely monitor incoming information and assess implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance on monetary policy that is sufficiently restrictive in order to return inflation to its 2% over time. The wording is a departure from previous statements, which indicated ongoing increases would be appropriate. The U.S. banking system is resilient, so they also added comments about the banking system given what happened.
Is it resilient or do they need bailouts? I don't think it's very resilient. I think
right now, the banking system is holding up pretty well given what's happened. And it looks like that was a totally isolated incident with some expansions only due to mindset of depositors. So I think so far so good. You can go read the latest announcement in full on CNBC.
Yeah.
But thanks everybody for...
Yeah, I don't think this is a bad move, and I don't think it should affect rates. In fact, I'm going to predict right now, Ray, that rates go down next week.
Yeah. Did I say reflation? Matt said reflation. It's a Biden term.
Yeah. He makes a lot. Yeah.
Dusty's anti this increase. She says I knew they'd do something stupid, she said. They shouldn't have done it.
I'm with her. But I don't think this is too big of a deal. But I am definitely with her. This is a reflation.
If you guys tuned in last week, this is what I predicted would happen this week. I thought it was going to be a 0.25 point. I think it has to be a 0.25 point because I think if they said no increase, it would signal that there are bigger problems in banking than they care to admit. And people would think, oh, there must be something really bad going on in banking that all of us don't see. So I think the 0.25 point was necessary to keep everything kind of steady, on the right track, steady. Yeah. No major changes one way or the other. So I would anticipate that if everything goes well and inflation either remains the same or goes down a little bit, that next time we will have no change. So that's my prediction early in from March 22nd. Well, thanks everybody for joining us. Dan, I know you got to go pretty quickly, so why don't you tell everybody where they can find you, man?
D-Ludwigers, do me a favor, go give me a like and subscribe there and comment on my videos. And also go to our channel, This Week in Real Estate. Like, comment, and subscribe. Please, we're begging you. We need to get to 1,000. We're almost at 400, so I appreciate it. Ray, where can they find you?
Stuff. You can find me at Ray Zorback. That's RayZorback. Everywhere good Razorbacks are sold. Mainly on Instagram. Find me there. That's a jumping off point for everything else. If you guys have any questions or if you want some additional banter, as Matt Lamar says, he misses the banter. We had a very busy news day.
Yeah.
Very busy. We're trying to mix it in as we go.
We're also trying to get better an hour, Matt, so just comment down. You are the banter, buddy. You are the banter.
You are the banter. So we appreciate you guys. Thank you so much for joining us.
Guys.
We will see y'all next week.
Bye.